Hey, what's up, everybody? This is John Bloor coming to you live with another segment of Trading Power Out of the Money Options. Filling for Stephen Choi today, who is work to do. So I'm going to finish up our presentation that we've been walking through. This is the third installment and the final installment in this presentation. So before we get there, quickly touching on the markets, we got some flat markets today. Nothing's really happening too crazy. Small caps are down a little bit, but mostly from what people are saying, it seems like a lot of profit taking. Nothing crazy happening. Of announcements coming up over the next 2 weeks. We have, well, this week we have retail sales and producer price index. Next week we have FOMC announcements. So if you're putting on positions this week, I would definitely keep that in mind. FOMC announcements are going to be out next week, so you definitely want to make sure that you keep that in mind as you put those positions on. I personally try not to put on brand new positions right in going into those announcements. Macro view, if you did a statistical analysis on that, I'd probably bet that it doesn't matter much, but short term, for me, it just makes me feel warm and fuzzy inside knowing that I'm not putting it on before what seems like somewhat potential volatile event. But again, if you did a study on that, and actually got the facts and the figures, I'm not sure what it would say. My guess would say that it probably says that it doesn't really matter. But anyway, let's get back to the presentation. If you remember last time we talked away millions because they had carried so many of those cheap out-of-the-money options that they had exploded in so much value. They were able to cash out with some pretty large gains. We also talked about the how units work in terms of the volatility skew and the volatility smile. This is a standard volatility smile, and how with units, when there's a massive volatile event, the entire skew smile actually shifts upward, and this is why they're so powerful. So now let's get into what is a good skew to sell. I like to start this by saying, I do not become a robot and blindly sell every expiration cycle at the same time, and also do not manage the trade without a brain. What do I mean by this? I mean, don't become a robotic trader. So especially engineers who get into trading, and a lot of engineers get into trading options because it appeals to their analytic and logical sides. I'm an engineer by trade as well, computer science and finance majors in college. So I totally get this. You think really logically, you think by numbers and statistical, and then you want to get into what are the exact steps I need to take in order to make this trade successful. You want to back trade that or back test it, and then say, okay, if I just do X at this time, Y at this time, and Z at this time, then the trade's going to be a success every time. And you just can't trade like that because the markets are very fluid. Things are always changing, and there's so many factors to take into case. For example, if you traded very robotically, that could work out for a number of months in a row, and you could think that you're a genius. However, October 08 comes around, all of a sudden factors change. Now, do you want to still blindly and robotically sell into that market? Probably not. You probably want to take a look at the landscape, take a look at the economic landscape of the world, especially the U.S. economy at the time, and say, okay, maybe I shouldn't on based on my rules that say, go ahead, reposition, and also double down on my trade. Maybe you want to, think about that before doing something. So you can't just blindly trade like a robot. You need to think, you need to be a trader. So be smart, be a trader is what I like to say. Take all factors into consideration. Rules are great. Rules are there to help give you a framework for how to be successful, but they're not there to guide you no matter what in all circumstances all the time. I mean, you could use a simple example of, the speed limit is there for safety, but, if your wife gets into an accident and she needs to get to the hospital, no cop's going to pull you over and start writing you a speeding ticket if she's bleeding to death in the passenger seat. That just happens to be a guideline and a framework at that point. So, use your trading rules, your guidelines. Stick. It's smart to stick to them. Don't just deviate from them because you have a gut feeling, but look at the landscape, look at the holistic, the macro picture of the economy, what reports are coming out, what data you're getting. You got to look at everything, and then you got to make a decision based on that. So be smart, be a trader. So kind of what is a good skew to sell? You want to sell a steep curve ideally. Selling a flat curve is not going to do you any favors. So what do I mean by sell a steep curve? That volatility skew, that volatility smile that we've talked about and I've showed a number of times, you want to make sure that it's steep and that you're getting a good skew on anything that you're selling, or a good price essentially. Now there's a couple of ways of figuring this out. You can do a little math, which you've seen me do before, which is just go into the expiration option chains and then go take the 10 delta option and then divide it by the at the money option. And this is going to give you what the skew is, and you can base that on the number that I give right here, which is 135 to 140%, and that'll give you an idea of kind of where you're at. So the SPX normally falls within this range. So if you're getting above 140%, that's probably a good skew. That's favorable. That's maybe something you want to think about selling. Now again, why is the skew so good? That's something that you also want to look at. So if you do the math and you find yourself in a very favorable skew, you want to ask yourself, why is this skew so favorable? Is it possible that there is some big announcement that's coming up, or some big event that everybody's worried about, and that's why the skew is good? I find this happens a lot with people who trade individual stocks, especially with calendars and other things. That they want to sell calendars, they want to get a good skew, and they find a bunch of calendar plays or even earnings plays, and they say, man, these skews are great, I'm going to go ahead and jump in here and I'm going to make a ton of money. But then you got to look at it and say, oh wow, there was just a huge announcement on that pharmaceutical drug, and no wonder the vols are so out of whack on that stock. To look at what's going on, look at the landscape, and find out why there's a good skew. With indexes, you don't have to worry as much about specific maybe news events, but a lot of times you have to look holistically at the economy and say, okay, is there something big happening that I need to worry about, and this is why we're getting a good skew, or is it just an anomaly and a great opportunity, an arbitrage opportunity? If it's a great opportunity, you dive in. If there's something bigger picture happening and there's a lot of fear and you yourself are worried, then maybe you want to hold off. But let me show you how to do the math on this. So let's look at August. Let's go and find our 10 delta, where I just went right past it. Oh, my deltas are not showing up. Oh, that's not fortunate. I must have a slow internet connection because my deltas are not showing up. Okay, well, I'm gonna have a little trouble showing you that then. Let me click on one of these options, see if it'll show up here. No, it's still not loading. Okay, well, you've seen me in other videos do this. It's just a simple math. You find the 10 delta put option, and then you're going to get the IV of that, and you're going to divide it by the IV of the at the money put option, and that's going to give you a percentage, and then based on that percentage, you'll kind of know if you're getting a good skew or not. And if that percentage is somewhere around 135 to 140, that's going to be typical for the SPX, even the Russell. If it's a little lower than that, then that's a little kind of a flat skew. If it's above that, that's a good skew. That's a steep skew. That's something you might want to look at selling. So keep that in mind. The other way of figuring this out, this is something I also do, is sure I follow this sort of framework and this guideline for if it's a good skew, but I also go ahead and I track the prices that I get for every single trade that I do when I'm selling far out of the money options, and I also track the volatility and the skew in a spreadsheet. Excuse me. So, so when I put on a trade, every time I put on one of these far out of the money option spreads that I'm showing in this presentation, I'll go ahead and I'll log the price, I'll log what this skew number is, and then I'll also log the IV for the options that I'm buying and I'm selling. And what that does is it gives me a past history to look at to know if I'm getting a good price or not. So I can go ahead and you want to look and do comparisons with the good trades that went well that you were in and out of versus the bad trades that were a little tougher versus even the trades that were losers. And then you can go ahead and find out what tends to work and what doesn't. So for example, I find that when I sell a high RVX, I tend to be in the trade a very short time for a few number of days, and I always make my money pretty quick and I'm in and out. And I find that correlates with getting a good selling a steep skew as well. So that's a few numbers that you might want to track in spreadsheets every time you do a trade, and that way you can go back, look at your history, and then you'll know exactly if you're getting a good price or not. This plays to the point I made earlier in the presentation about knowing your underlying. This is why I personally, and a lot of other really successful traders I know, like to trade the same things over and over and over and over again. Remember, wealth is boring, rich is fun and flashy. So if you want to build wealth, get boring and just do to 15 contracts sold. Um, this is going to provide us a hedge and some protection. It's also going to boost the graph towards your short strike and give you more profit as you're taking on more risk. So as the market moves towards your short strike and you're taking on more risk, you're also going to see more reward because there's going to be more profit in the position. You also want to buy a couple of units until your net long put options. So I like to be net long put options when I put trades on this on, and that's because when I trade these, I'll trade them with so I'm trading more than just one contract. If I was just trading one contract all the time, I trade multiple accounts and I trade several contracts in each. So If I was just trading one contract, for example, then I might not worry about the units as much, because if, worst case scenario, if I got a max loss on that trade and I lost a couple $1,000s, I'm not standing on the street, begging for money. But if you're trading with a little bit of size and you're trading a larger account, a larger percentage of your account, if you're trading 10,000, 20,000, 30,000 in these positions, you certainly want to have on some units, because you lose 30 grand. I don't care how wealthy you are, that doesn't feel good. All right, next is selling a good skew, and this is most likely going to happen on a down day. So as you know, today we're down a little bit, but we're not down a lot. So we're down. Let's just look. I looked at possibly putting something on today, but we just weren't. We're down 7.5, 8 points on the Russell. So typically speaking, this might be an okay day to sell. You might get a little bit of a vol spike, but when you look at the RVX, we're sitting at 1834 in the RVX. That's kind of a crummy RVX to sell. That's not good, and that's just because we've moved up so much in the last few days, and even a small spike in the RVX here today is not really a good price still. So we're just not there yet. But you're going to get that down day, and it's going to happen in the next week or two. I mean, we got a lot of announcements coming up. There's going to be some fear. Something's going to happen. We'll get that day, and when that comes, you just got to wait. You just got to wait for it. Don't get too anxious. And when you get that day, make sure that you're ready and you're there to jump in. So here's a good point to reiterate why I like to wait for those down days. Last year, looking back in my trades, and this again speaks to knowing your underlying and tracking your trades, and just methodically and analytically trading these positions. Last year, when I traded an RVX over 20, I was in the trade 17.5 days. I was in the trade about 33 days. That's twice as long, guys. Twice as long. You can imagine the exposure I'm getting by being in the market for 33 days versus 17 days for a position. I mean, if somebody told you that you can put on a trade, make 4%, and be in the trade 17.5 days, or you can put on the same trade, be in it for 33 days to make 4%. I mean, what would you do? Of course, you're going to take 17 days all, every day and twice on the day. So you want to make sure you wait for those good down days. And you might not get an RVX over 20, but you still want to make sure you get a good skew relative to where the market's been at for the last few months. So if we're in a very low volatile environment for a few month stretch, you might not be able to sell an RVX over 20. You might have to sell 19. But as long as it's high relative to where it's been over the last few months, I think that's really what you got to aim for. When I became more selective about the days that I put this trade on, I became much better at managing it, and I became much more successful with it, and I had fewer losers and more winners. So don't get too anxious. I know you always worry about the opportunity cost. If I'm not in the market, I'm not making money. But trust me, that down day will come. You'll get a good price, and you'll be able to get in. It always happens. Again, the return on these can be anywhere between 10 to 15% in a PM account. That's portfolio margining for you people that, for those that are not aware. If you don't know what this is, then you probably can't qualify for it. I can't qualify for it either, so don't worry. Usually you need about 125K in your account to have a portfolio margining. Any Reg T account, Reg T is what I trade, you're going to make about 3 to 8%. 8% if you're aggressive, 3% more towards the lower end. And that's going to be on a per trade or per expiration cycle basis. And here's kind of what the trade looks like when you put it on. You'll see it's kind of like a credit spread, and then because of that at-the-money hedge we put on, you'll notice it pops up as you get towards your short strike. And then if you were to expand this out further, you'd see a nice curve going upward back here, which is kind of off the screen, and that's due to the unit options that I bought. So that's what those would be. So management of this position. How do you manage this broken wing condor? If the short option gets to 4 delta or less, I'll sell a debit spread to increase the theta and pop up the expiration graph, meaning more money in the trade. Now again, these are my rules for trading this, and I didn't make these up myself. I've actually worked with a lot of people and kind of stood on the shoulders of giants to get these rules. I wish I could take credit for them, but I'm just not that smart. But I'm smart enough to know that I should follow people that are very successful in trading and sort of, you know, follow the path that they've already laid. So the next rule is, or guideline I should say, is if the short option delta gets to 16, I take notice and I think about rolling down. So when it gets to 16, I really take notice and I say to myself, okay, maybe I need to roll down now. If I think the market's going to pop back up and I'll be in a good spot, then I might hold off. But if the market's moving down quick, I usually roll down. If the short delta gets to 18, I definitely roll down 30 points, and I increase the contracts to make up for the loss. Now, I know what you're thinking. Throwing money at a bad trade, throwing more money at a bad trade is never a good idea. But you know what? I only do this if I think it's a good environment to do it in, meaning if I'm not that worried about the economic environment, I look at holistically what's going on, and I feel good about everything, and I feel like we just had a short run down, and we're going to either stabilize and come back up, then I'll roll down. If I think we're going to continue to fall through the floor, and the skies are falling, and everybody's panicking, and the banks are going to collapse, then I probably wouldn't do this. I'd probably just take the position off and cut my losses. Again, never roll more than once. That's kind of what I do. I don't like to play that marquee betting strategy. I like to just go to. And again, these are just guidelines. So be a trader and always, 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 always trade with a trading plan. All right, guys, that's part 3. Next, we'll talk about. Oh no, wait. We only have one more slide to cover. I'll cover this. Trade exit. Typically, when I exit, I'll capture 80% of the profit in the short options. So try to get about 80% if everything goes well and you're in the trade a short time. And then if I roll down or if I have to fight the trade, I might hold it to expiration. So to think about this for the May expiration, with that blog post I wrote, I showed how I held on to the trade until expiration. And the reason I did that was because I had to fight the trade. I had to roll down. I did increase the contracts. The trade ended up a winner, but since by the time I got about 80% of the profit and I'd made back my loss and made my money, I was already about 2 weeks, maybe 10 or 12. So at that point, it just becomes like, well, you know, almost why even pay the commissions and take this thing off? It was so far out of the money, and I mean, the odds of it actually winning or losing were so slim that it just became, you know, keep an eye on it and just hold on to it and just let it run. And to be honest, if we would have ran down a little bit, I probably would have gotten to that larger profit zone. I would have gotten to this bigger area of the graph here. I would have probably been pretty happy about it anyway. And then once the short options decay down to 20 cents or less, you know, take them off. Again, that's if you're not going to hold until expiration. And that's because once you get down to 20 cents, you're not going to get much more decay past that. The option model is flawed when it comes to far out of the money options that are worth less than 20 cents. It really is. You're just not going to get any more decay, and those market makers aren't going to give you a good price on those. You know, if